Hello and welcome to the Intelligent Investor Summary by Ben Graham. In this video I'm going to be talking about the key principles in this book, and if you like book summaries, be sure to subscribe to my channel as I'll be doing one new one a week. So although this book is pretty outdated, it does have some key investing principles that are going to be very good to help guide your investment strategy. So the first one is don't rush in and examine the long-term value of a stock. So there are a lot of speculators out there in the market and they try and make money from stocks going up in value because of an event. So say when Apple go to release their new iPhone, stock market speculators are going to get in and try and buy that stock before the announcement. When the announcement comes, then the stock will go up in value and they'll end up getting profits from that. On the other side then, say a company could be faced with litigation. Stock market speculators try to get in and they'll short that stock then before the event, and once the news is released, they'll make profits from that as well. But you as an intelligent investor, you want to try and buy a company that is that has a higher intrinsic value than the stock market price. So say a stock is trading for £10 on the stock market. You are going to want to do a valuation model on a company and see that the intrinsic value is higher than that £10. So if it's only at £10.50 for the intrinsic value, it doesn't have much wiggle room there above what the stock market price is. So you want a good margin of safety. And the way they reference this in the book is, say you're building a bridge and you know that people going over that bridge, there'll be a sign saying it's 100 tons capacity. You'll want to build that bridge to be able to hold a capacity of 150 tons, and it gives you that margin of safety. And bring that principle over to investing then to have a good margin of safety with your investments. The second point is the three principles. So these are the three principles that you need as an intelligent investor. So the first principle is to look at the long-term development and the business principles of that company. So the first point in this is the finance structure. So see how much debt and equity there is in the business. Normally if there's more debt in the business, it has inherently more risks involved with it. So in a downturn, if a company has a lot of debt, they have to pay back all of those debts, and they may have to sell some of their assets then at a fire sale price to repay these debts. Whereas if a company has more equity in the business, those shareholders in the company will take the loss there as opposed to having to repay back debts from a bank. As well then, look at the management in the company. Have they been involved with this company for a long time? As well, do they have much sector experience, or have they been involved in scandals in the past? These are really factors you want to dial into as well. On top of that then, you are going to want to not look at the short-term earnings for the company, look at it over a 5 to 10 year time frame. Some years company can have adverse shocks to their earnings, such as they're investing in R&D. So try and look at the trajectory of the earnings over the long term. Are they trending upwards? If they're not, then this isn't a company that's going to warrant an investment either. And finally then, to have diversity. So don't put all your eggs in one basket when you're investing. If you do this, you could end up having a massive shock to your portfolio. Say for example, you were invested in real estate heavily in 2008. When the market took a downturn here, your portfolio would have suffered massively because of how much of a hit real estate took. Whereas if you had a small part of your portfolio assigned to real estate, then you would have had the rest of your portfolio shoring you up and protecting the value you had within it. An intelligent investor realizes they won't pull in extraordinary profits, but they will get steady and safe returns over the long term. The third point is the history of the stock market is important. So although the stock price and the history of that is important, the history of the stock market is more important because history repeats itself. So if you know certain indicators in the past that have led to recessions, you'll be able to be aware of those indicators and see that they might come up in the future, and you'll know how to tailor your portfolio then based on them. As well, if you don't want to sell on the first sign of danger, so you have to be prepared psychologically and financially for different downturns that could come up in the market. So on the first sign of danger, not to just sell your whole portfolio, to realize that the market will rebound and to just stay in with your stocks and your investments. As well, you want to see the correlation then between the stock price and the earnings and dividends. When the stock price goes up, do the earnings and dividends do they go up at the same amount as well? If they don't, there could be a misalignment there between the stock price value and the intrinsic value. You also want to look at the real return that you're making on your investments. So say for example, your return on investment is 5% for a stock. You want to look at inflation then. If inflation is running at 2%, that means that you're going to have a real return of 3% because you get your interest return rate of 5% and then you minus the inflation rate of 2%. Inflation is going to have an impact on your real returns because they impact how much you can use your profits in the next year, because all the prices in the economy are going to be rising at that 2%. The next point then is don't invest with the crowd or follow the market. So in this example, Graham gives a person called Mr. Market, and this is representative of the stock market as a whole. So some days you can bump into Mr. Market. He's very optimistic and happy about the outlook. So that is when you have a company like Apple and they're releasing the phone again, there's positive news that day. Mr. Market is going to reflect this and he'll be very optimistic like the stock market is. On the other side then, say a company falls short of hitting their earnings. Mr. Market can be very pessimistic about that company, even though the long-term fundamentals still might look good for them. So the moral of the story is, don't get attracted to the short-term gains that you can get from short-term market fluctuations. Always stay and have a look at that long-term view instead. The next point then is the balance of a defensive investor's portfolio, and this will make it easier for them to invest on a regular basis. So for a defensive investor, you would want a balance of 50% in stocks and 50% in bonds. If you have this much weight in bonds, it will protect you in the event of a downturn. As well then, if you are a more defensive investor, you would have 75% in bonds and 25% in stocks. In that stock portfolio then, you would want 10 large blue chip companies, so the likes of your FTSE 100 or your Dow Jones 30, they would make up those holdings for you within the stocks. You would also want to have a look at different fund managers. So for any of those of you who don't know how to look at fund managers and their fact sheets, I have a video popping up in the top corner that will show you how to do that. But you want to look at the best holdings that these investors have and see if you can tailor any of them into your portfolio as well. And you want to take a method then for investing called dollar cost averaging. This is when you take a regular amount and you invest it over a certain interval. So say for example you have £100 left at the end of every month, to invest this into your stock or bonds to grow your portfolio over time. And the market is going to fluctuate in terms of going up and down. So if you keep dollar cost averaging, you will be taking advantage of the low points in the market if you do that. Then when you are investing as well, all these stocks that you invest in, you would want them to have an absolute max of 15 times price to earnings ratio. So this means that the price of the stock is 15 times the earnings. If it's any more than that, then the stock could be overvalued and it's projecting to have a lot of future revenues there, which is a lot more risky than having a low PE based stock in your portfolio. And then the final point is the enterprising investor. So an enterprising investor is someone who has the majority of their holdings in stock. So they are looking to benefit off the increase in stock prices. They won't have any more than one holding taking up 10% of their portfolio, as they will realize that Mr. Market can be irrational and can lead to stock prices decreasing in any of your holdings within your portfolio. As well as that then, you would want to know the directional flows of the market as an enterprising investor. So don't let Mr. Market influence you to get into the market as well. Getting back into that whole idea that Mr. Market fluctuates and is moody, so to not get caught up in that and really take the long-term approach when you are investing. You would want to buy when you are in low markets and then sell in high as an enterprising investor as well, and then check your portfolio on a regular basis and to be able to do your due diligence on the management and on those other factors that initially made you invest to see if they still are the same. Well, look, that's pretty much it for this video on the summary of the Intelligent Investor. If you thought this video provided some value, hit the like button and I'll see you next time. Thanks. Hey, thanks for watching. Subscribe to my channel now to see more content like this in the future. See you soon.